Well, we start from a different standpoint. In our view, the real economy and the financial markets went into this crisis in a pretty good and healthy shape. And the reason why we are going to see a pretty sharp downturn is mainly due to the pandemic. So the main advice that we give to our clients who are more longer-term investors is that we are at the point where we start seeing some light at the end of the tunnel, meaning that we all know that the recession is going to be pretty deep in the second quarter of the year. But assuming that the social distance measures play out in flattening the spread of the virus, and considering that governments have taken very quickly quite sizable spending measures to support the economy, we think we can start looking through the second quarter and perhaps watching toward what is going to happen when we think about, the recovery. The recovery that we have in mind is a sharp one. The fast recovery, once again, the pandemic is under control, is due to the policy measures in place. And so the advice we give to clients is that perhaps is the time to start very gradually looking to U.S. equities and adding U.S. equities to your portfolios now. We are not obviously calling the bottom of the market. Nobody in our view has the visibility or the ability to do that in a consistent base. But as we know, financial markets are forward-looking. And so for those who, we in our tactical portfolio, in our advice to clients, we start getting more positive positions, more bullish positions. First, we had done so through options, and a week ago we had started adding outright U.S. equities.
So that's fascinating because I know that there are those in our audience who will be listening here who will say that that is very best case scenario. We've gone into this crisis after a very, very long expansion coming out of the liquidity from the global financial crisis. Many were expecting the end of that cycle anytime over the last 18 months. We also know global debt to GDP at 322%, I think as it was from the IIF data, shows that we find the corporate sector, the non-financial corporate sector, quite leveraged as we come into this crisis, as is the household sector in many countries. It's interesting you see a V-shaped opportunity here and that you're already adding long side positions.
Your points on the stock of debt and on the fact that the expansion has been very prolonged is certainly a fact. But there are other facts, other pieces of evidence that need to be considered together with this one. First, on the length of the expansions. I mean, expansions in general don't die of old age. They die either because there is a substantial monetary tightening because of an inflationary problem, or they die because there are big financial bubbles in the financial sector. As for the first reason, I mean, we know that the Fed has eased last year. We were expecting the Fed to stay on hold before the pandemic. Now we have seen significant easing that has been obviously put in place to counteract the significant, very high negative shock that we are all facing because of the pandemic. But as for the financial sector imbalances, I mean, although the stock of corporate debt, for example, in the US is very high, the affordability of this debt is very low. Interest rates are very low. If you look at data of the ratio of the interest debt services, it's at the lowest it has historically been. And again, we expect, after this period, we still expect monetary policy to remain very easy.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.